Welcome to our recap. Welcome to our recap. The U.S. stock market has experienced notable developments in the last 2 days, marked by a mix of corporate earnings, Federal Reserve decisions, and ongoing geopolitical tensions. The S&P 500 index briefly touched 7,000 for the first time before pulling back, demonstrating the market's current volatility. Despite some daily fluctuations, U.S. stock indices largely remain near all-time highs, reflecting resilience amid macro uncertainty. What a ride! The Federal Open Market Committee, FOMC, concluded its January meeting by maintaining the federal funds target range at 3.5% to 3.75%, as widely expected. This decision follows 3 consecutive rate cuts in late 2025, signaling a more patient stance from the Fed. The unemployment rate shows signs of stabilization, while inflation, though moderating to 2.8%, remains above the 2% target, with the pace of disinflation slowing. Monetary policy appears close to neutral, and analysts anticipate the Fed will pause for at least a few months before considering additional cuts, assuming inflation continues to moderate and the labor market stabilizes. The U.S. economy is projected to grow above its potential pace in 2026, with an average annual growth rate of 2.9%, an improvement from 2.3% in 2025. This resilience is attributed to AI optimism-linked investment and consumption by wealthy consumers, benefiting from historically high stock market valuations. However, inflation is expected to continue overshooting the target at 2.7% in 2026 due to tariffs. The labor market is experiencing a slowdown in both demand and supply, partly due to the administration's immigration policy. Political pressure on the Fed chair risks undermining central bank independence, potentially prompting investors to favor European government bonds over U.S. Treasuries for safe haven exposure. Geopolitical events continue to be a significant source of market volatility. On February 3rd, markets reacted sharply after the U.S. shot down an Iranian drone, although talks between the two sides are still anticipated. This reignited risk-off sentiment, leading to corrections in cryptocurrencies and equities, particularly high-beta assets. Simultaneously, the U.S. partial government shutdown is ending early after Congress approved $1.2 trillion in funding, which helped calm selling in markets and triggered a rebound in U.S. equity indices. Earlier, January saw heightened geopolitical tensions between the U.S. and Greenland over strategic resources, which caused the S&P 500 to experience its largest one-day drop since October, after the U.S. threatened higher tariffs on NATO members opposing an acquisition. However, equities rebounded quickly after the U.S. softened its stance, ruling out military force, but insisting on a framework deal for expanded U.S. military and mining presence in Greenland. The U.S. dollar weakened amid the partial government shutdown and delayed economic indicators, with safe haven assets like gold rising sharply. Global markets struggle with unclear political news, which can lead to volatility, currency movements, and defensive positioning. On Wednesday, U.S. equity markets finished modestly lower as the Fed held rates steady. The S&P 500, after briefly hitting 7,000, pulled back. The energy and technology sectors saw gains, while interest rate-sensitive real estate companies lagged. On Tuesday, U.S. equity markets closed lower, primarily due to weakness in technology, particularly software stocks, as concerns about AI models eroding market share persisted. Cyclical sectors like energy and materials outperformed, alongside defensive consumer staples and utilities. Monday saw a strong start to February for U.S. stocks, with the S&P 500 gaining 0.5% and the Dow Jones Industrial Average rising 1.1%, shaking off a few days of weakness. This rebound was attributed to investors buying the dip and an easing of tumult in the metals market. Small-cap stocks also performed well, with the Russell 2000 index gaining 1%, despite rising Treasury yields. Palantir Technologies, Inc. Shares moved higher this morning after the data analytics firm reported strong Q4 adjusted earnings of 25 cents per share, beating estimates, and Q4 revenue increased 70% year-over-year to a record $1.407 billion, exceeding expectations. The company also provided upbeat guidance, with Q1 revenue expected between $1.532 billion and $1.536 billion, and full-year 2026 revenue projected between $7.182 billion and $7.198 billion, both above consensus estimates.
PepsiCo Inc. Shares were also up this morning after the snack and beverage giant reported Q4 adjusted earnings of $2.26 per share, beating estimates, on Q4 revenue of $29.343 billion, exceeding expectations. PepsiCo announced a 4% increase in its annual dividend and a new $10 billion stock buyback program. The company guided full-year 2026 revenue to a range of $97.682 billion to $99.561 billion, above the consensus estimate. Advanced Micro Devices. The stock sank more than 8% in extended trading after issuing a weaker-than-expected Q1 forecast. Chipotle. The company slid about 6% as traffic fell for a fourth straight quarter. Match Group. Shares jumped 7% on stronger-than-expected earnings and revenue. The Walt Disney Co. The stock dropped nearly 7.4% despite reporting better-than-expected quarterly profit and revenue, as investors focused on CEO succession. IDEXX Laboratories. Shares fell 5.5% after the veterinary health company stated that clinical visits remain under pressure. The upcoming days will see continued focus on earnings, with Alphabet, Google reporting tomorrow, and Amazon on Thursday, followed by NVIDIA mid-month. This earnings season is expected to be robust, with fourth-quarter S&P 500 earnings projected to grow about 10%, led by the technology sector with over 30% growth. Looking to 2026, earnings growth is expected to remain healthy at over 14% for the S&P 500. Looking ahead to next week, market participants will be closely watching several key U.S. economic data releases. On Tuesday, February 10th, U.S. retail sales will be announced. The week's key event will be Wednesday, February 11th, with the release of the Consumer Price Index data for January. Additionally, the Producer Price Index for January will be released on Friday, February 27th. These inflation figures will be crucial for gauging the Fed's future monetary policy decisions. Geopolitical tensions, particularly involving the U.S.-Iran talks scheduled for Friday, will also remain a top risk catalyst. The S&P 500 is currently trading near all-time highs, with resistance likely around the recent intraday high of 7,002.58 reached in January. Support levels have shown resilience recently, preventing significant pullbacks.